Welcome to this webcast about the designated derivatives. This is webcast 5 out of 8. This webcast is separate to the general overview webcast and focuses on the definition and the determination of the designated derivatives. Designated derivatives are derivatives traded by an entity to mitigate the interest rate risk from its current net open risk position. As the name suggests, other types of financial instruments that are not derivatives cannot be designated derivatives. If the interest rate risks from those financial instruments are managed holistically, they may be considered as part of the current net open risk position instead. Plain vanilla interest rate swaps are expected to be the most common types of derivatives an entity may use for the purposes of interest rate risk mitigation. As well as discussing these standard instruments for inclusion, the IASB will also consider whether non-linear derivatives, for example options, can be designated in the future. Regardless of the contractual format of the designated derivatives, they shall all have an economic relationship with an entity's current net open risk position and reduce the interest rate risk exposure from that position, which is a similar requirement to what IFRS 9 currently requires.
Secondly, the entity is required to formally designate or de-designate these derivatives at the beginning of each DRM assessment period to reflect the entity's risk management activities and objectives for that period. This means, for example, an entity shall not designate a derivative in the DRM model if it is used for trading purpose, or de-designate a derivative when the risk management objective for that particular derivative remains the same. This is important to ensure the better reflection of risk management activities in financial reporting. Furthermore, designated derivatives are required to be external to the reporting entity, and internal derivatives cannot be designated. This is consistent with the general hedge accounting requirements and ensures the designated derivatives genuinely achieve the interest rate risk management purpose and mitigates the risk at the reporting entity. Also consistent with the general hedge accounting requirements, generally speaking, a qualified derivative must be designated in its entirety. Although the entity may designate a proportion of the notional amount of the derivative if that's consistent with the actual risk management objective. However, an entity would not be allowed to designate a portion of the time period during which the derivative is outstanding.